Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp, and it's great to have you with us this morning. Also with us this morning will be Christian Lundblad, Kenan Institute Research Fellow, and he's going to talk to us about another set of rather surprising job numbers. That's getting to be a thing these days. He's also going to talk about the state of the world. We have a war in the Mideast. What is that affecting in the economy? We see a lot of talk about oil, but there are other stories going on behind the scenes. Christian's going to elaborate on those. He'll be with us in a couple of minutes. He is going to give a presentation of 15 to 20 minutes, and then it is time to open it up for your questions. You can ask those using the Q&A function at the bottom of your screen. You might find it inside the More button with three little dots, but you can use that to let us know what you want to know about. If you are with us by phone today, you can email me questions at rob_knapp@kenan-flagler.unc.edu. Either way, if you're with press organization, please let us know. We'll make sure that those questions get answered. We'll be here till 9:30, maybe a touch longer. We want to get your questions answered, so we'll get going right now. Joining us again this morning, Christian Lundblad, who not only is a Kenan Institute Research Fellow, but wears a finance professor hat and several other hats across the courtyard at UNC Kenan-Flagler Business School. Christian, great to see you this morning.
Great to see you, Rob. Thanks, everyone. So let's dig in, frankly. So we have kind of an interesting bit of volatility, perhaps, in the labor market. So if you see kind of the headline numbers here, a surprise to the upside, frankly, on job creation, but let's temper that a little bit with a couple of things. One is if you look to the right, you can see that the revision in the kind of negative numbers that we saw in the previous month have only been made more pronounced. So collectively, when you put all this together, the kind of rolling, average, as it were, of job creation is a bit more muted. Where else did we see some surprises on the upside? The unemployment rate fell in a way that I think we didn't particularly anticipate. So you put all that together, and that's reasonably good news about the labor market. On the other hand, participation slipped a bit, and we saw some moderating in the level of labor cost expansion. So earnings actually fell a bit, and I just want to also make it very clear that sitting here on Good Friday in April, and welcome to all of those of you who celebrate. This is an odd day in the sense that a lot of things are closed, and so markets are muted from that perspective, or even outright closed or in abbreviated trading. And of course, the second thing to note is that these data do not fully internalize kind of everything that we're going through right now in terms of conflict in the Middle East and the implications for energy costs and all of the pass-through effects that might be manifesting as a consequence of that. So we'll talk a bit about that on a go-forward basis, and I'll also connect that with a little bit with sort of what are we learning here, where do we need to keep our eye going forward, and how are policymakers sort of struggling with this as well. And so, again, just to be clear, here's kind of the typical number that we're going to glean from this. The first number we're going to focus on is the non-farm payroll number. It is up, if you look at the very end, in a surprising way, and that's on the back end of now an even larger decline in the previous month. I would encourage you to look at the 3-month moving average, and from that we can see clearly a couple of things. One is that it's not disaster city by any means. The U.S. labor market continues to move forward, but we're also very far away from the kind of post-pandemic hiring boom. But I do want us to make it clear that there is some conflict here in terms of us understanding a little bit kind of where we are, even leaving aside perhaps what's happening in the Middle East. And I say that by thinking about sort of the tensions that might be manifesting between the demand for labor So when we think about hiring plans and growth expansion from the U.S. corporate sector as well as the government sector, and the supply of labor and kind of where that's going, and the answer on that is super important, right? And so we need to struggle with that as well, and then we can kind of marry in to some degree what might be happening elsewhere. On the unemployment rate, again, clearly that has been ticking up to some degree. It has triggered some rules that are out there, the Somme rule amongst others, that ought to get our attention. If you sort of have an increase in that unemployment rate, that starts to signal obviously some recessionary concerns. 4.3% is where we are. That's down a little bit from where we were the previous month, but the trajectory matters perhaps more than the level, and we're clearly up from that trough we saw in the post-pandemic environment. But again, what's happening sort of in that slower, more secular move, as opposed to what's happened over the last month, is that really about demand falling. We want to look at other things too. We want to look at sort of what's happening in terms of hiring and firing and quits, what's happening in terms of hours worked, which were off a little bit this month. And so it's collectively a good report, but it does signal some things to scrutinize as we sort of go forward and try to glean kind of a better understanding really of where we are. I do want to highlight one interesting thing, which is I think we are getting some suggestions about demand holding up in certain sectors of the U.S. economy. Healthcare is obviously one. The strike issues and some of the volatility associated with that notwithstanding. But there are other concerns as well, which are in the supply side, right? And the supply side in the labor market is complicated, frankly. We do see things like this. So kind of overall labor force participation among prime-aged workers. That's what's in the orange over here. That has completely recovered in many ways. It's backed off a little bit, but not a lot. And certainly when you contrast it with the grind that we've seen over the course of the post-COVID boom, over the post-COVID recovery, I mean, that is pretty impressive. Like that 25 to 54-year-old labor force engagement, whether they're working or actively looking for work, I think is pretty impressive. The overall labor force participation rate is a little bit more muted, and indeed that's the number that formally ticked back in the past month. But this is only part of the story, I would say, and there's maybe two other dimensions I would like to identify as deserving of your attention. The one I think is one we've been talking about for a while, which is the labor force participation amongst older workers. And since COVID, that just simply hasn't bounced back at all. And so this means at a minimum, there are several million workers that have just simply exited the workforce for a whole host of reasons, retirement and lifestyle choices and the like. That number, if anything, has been slipping. There's some demographic factors in the background. Obviously, you can think about, baby boomers and the like, sort of increasingly, exiting the labor force, just so for natural reasons. But at a minimum, this is indicative of the part of the supply of labor exiting, and this is also quite acute along other dimensions too, because many of the skills that are needed amongst employers are disproportionately sort of represented here, and not so much amongst younger workers, or at least not in the same levels. And so there is maybe an exacerbating of the skills mismatch that's a consequence of this particular development. So the supply component is important here, and we ought not lose sight of that. That's true anyway. It's always been kind of a reflection of a skills mismatch that's been in place. Some pockets of the labor market are relatively expensive and in relatively short supply, and I think that's only becoming more pronounced. And that's the second piece. The third piece I want to mention before moving on to the energy cost question is on the immigration side. And so here's a really interesting study from Brookings. There's other work coming from the American Enterprise Institute and a whole host of others, which just highlights the consequence of some of the really fundamental immigration shifts that have taken place. And so if you look at kind of the green, which is immigration, or the orange, which is out migration, the net immigration numbers are really impressive over the last several years, and obviously politically complicated. And I wouldn't suggest otherwise, right? But just from a purely economic standpoint, what's happening over here as a consequence of choices, enforcement, signals that the United States is making to potential immigrants and a whole host of other things. What we see over here is, really for perhaps the first time in a really long time, and certainly the first time in the historical data, the way we collected over the better part of the 20th century and into the 21st, is we have a shrinking of labor supply associated with this, and so you know what are we doing over here? We are having economic consequences as a consequence of that. I mean, you can have your political view on this, and certainly everyone's entitled to that. But just from a purely economic perspective, this means that the labor supply is very different, and this is hitting certain industries quite hard: construction, hospitality, agriculture, and some others. And so, you're not going to grind your way out of a slowdown if that's indeed the slower move that's happening, despite the impressive labor numbers we got this month, with a reduction here very easily. I mean, you kind of have to pick one in a sense, and the administration has picked one, and that means then the tensions are going to manifest along another dimension. That all is in the background anyway. Again, pretty impressive labor report, to be clear. Sort of some slowing concerns in the background, although I would say the U.S. economy is clearly, on balance, reasonably resilient. But we do have some issues that are happening in slower movements on the labor supply. And then we've got movements like this. What's happening in terms of the cost side? The inflationary component is important, and that's the other side of the Fed's mandate that we've been struggling with, right? That actually ticked down modestly in terms of the labor market implication for this. So wage growth was off a little bit. You can see that here. But there is in the background some important degrees of fragmentation. Some pockets of the labor force remain expensive and are only elevated. That's the skills shortage that I mentioned. And then on the other hand, we do see a little bit of softening in this number just in the last month. But nevertheless, I would say it is still the case that wage growth remains robust, generally speaking. And if it were just about pure demand weakness, we'd probably see wage growth decelerating even faster. So there is a little bit of a tension here. Wage growth, does have a pass-through implication for overall inflationary pressures. And now we're back to what the Fed is struggling with. Is the labor market softening, and or are there wage concerns and hence inflationary concerns that we have to navigate? And that's the dual tension that the Fed always struggles with. And right now, I would say that feels like it's a little bit stretched out, right? A little bit in tension. And so where is the Fed likely to go as a consequence of all of this is a bit complicated. I would say the speech making that comes from the Fed right now is a bit more about, well, we're in kind of a good place, and the labor market is okay, and the inflationary pressures remain, but we're making progress. But we'd like to continue to see that go down to something more like the 2% that's commensurate with their target. I think it's a little bit more complicated than that, to be perfectly transparent. I think that tension they're all feeling, and I think that tension has only become more pronounced by what's happening right now along other dimensions, and that's in the energy space. And so let me talk about that for a few moments, and then I'm happy to open it up for questions. So here is a really interesting figure that gets at maybe a couple of things. So the black line here is WTI crude prices, over the last, year plus or so. And then what I did is I grabbed from the options market some sense of the uncertainty out there about where all this is headed over the next couple of months. I mean, if you looked at just sort of some baseline forecast, there's an expected perhaps moderation that's in the black line sort of going forward, the dotted black line. But I think what's most interesting is sort of the confidence interval that one might discern from the options market. Again, prices on contracts that are trading on contingencies. Pieces of paper that will only be valuable if WTI goes above X, or other pieces of paper that will only be valuable if WTI falls below Y, for example. And we can look at what market participants are essentially paying to hedge or speculate against or in favor of that uncertainty, and then reverse engineer a bit about what they're thinking. And if you look at a picture like this, essentially what the options market is telling me, again, not some professor, not some pundit, not some abstract or abstruse statistical model that's designed to glean confidence intervals, options prices, like where people are real putting their money. The confidence interval is basically saying that the options market is 95% sure that over the next several months, WTI crude is going to be between 240. I mean, thanks, right? That's a lot of clarity, but that's exactly what we're up against. And you can see that's deeply asymmetric on the upside. I mean, there's real expectations for, potentially elevated energy costs for the foreseeable future. And the longer this goes on and the more that gums up supply chains and everything else, we have some real potential concerns on the upside that would only exacerbate that dual mandate issue. And if you start poking around, there are some, reflections of that, right? So here are what we would call nowcasts for CPI, for example. And so in the blue, that's an exercise in nowcasting where CPI might be headed from Bloomberg Economics. In the green is a nowcast for CPI from the Cleveland Fed. So they're basically using other pieces of information to try to discern where CPI might come in going forward. We're going to get the March read in a little bit of time in April 10th. That's the first print that will probably have a better reflection, perhaps, of some of the energy shocks, although that will manifest, going forward, obviously, into future prints. And the purple there, by the way, is also coming from traded market prices. So that's from inflation swaps. And in all those cases, if you look at the far right, you're seeing sort of expectations elevated. And that's, if anything, suggestive of a real problem, right? And so you kind of put that together. And in a way, here's kind of the Fed's problem in some sense. I mean, we've got a real supply shock channel that could manifest. The straits closed, 20% of global crude comes through there. And the energy pass-through to headline CPI, even if you strip it out and only look at core and all of the things that might come because of transport cost and everything else, I mean, this has the danger of really re-anchoring expectations to something higher. There's also additional concerns, though, frankly, which is on the demand destruction channel. Like, what does this do to economic activity, right? And so energy price spikes, on the other hand, are a tax on consumers and firms. And so are we going to see some slowing spending and investment and hence hiring, right? I mean, this is already a resilient but fragile labor market, I think, is the way that I would put it to build on the conversation earlier. And so the Fed's in a tough spot, right? Do they tighten to contain inflation expectations? Do they hold, to ease to support employment if indeed that becomes, a dominant factor? And this is the tension widening out, right? And this is the classic stagflationary bind, where their dual mandate is sort of pointing in opposite directions in a way. And so the key question really is how to model this geopolitical shock that sort of simultaneously threatens markets via input cost and revenue via demand destruction, and potentially, what all that means for the household and sector as well. This is a tricky moment. And so here's the reality. The Fed's on hold right now, right? This is where Fed funds futures contracts are suggesting the Fed is likely to be in April when they meet. And so if you sort of look at that solid blue line there, that is an expectation based on financial markets about where the Fed will be when they meet later this month, right? And you can see that over time, whether we're looking at a month ago or a few days ago or all the way up to the present, that's kind of locked in increasingly on the Fed staying put. And again, the language they have is, let's wait and see, and we're in a relatively decent place. I think it's more complicated than that. I think they're facing this widening out, and there's things that they can do. They can't solve the Strait of Hormuz problem. And so I think ultimately that's a bit what they're up against. And finally, and then I'll open it up for questions, here's perhaps where they're expected to be by the end of this calendar year. And again, if you sort of look at that middle bar and where that's kind of firmed up, relatively speaking, in terms of the solid blue line there, that's suggesting the market is putting a pretty good probability on the Fed staying put for the remainder of this year. And that's very different from kind of where we were a bit earlier. You can see some of those lighter bars, were suggesting perhaps the Fed would be cutting rates over the remainder of this calendar year. I think the market is suggesting that that may be complicated if some of the other parts of their dual mandate continue to manifest. And so there's a lot going on right here. Again, sort of to sum up, a good labor report, to be clear. Some, you know, nuances there that I think we ought to acknowledge, and the supply component continues to be an interesting question that we ought to keep our eye upon. But there's really the dominant story right now is energy costs. That's just sort of trumped everything. And then the Fed's challenging dual mandate, I think, has only become more complicated in such a setting. So with that, I'll pass it back to you, Rob, and then and take any questions that there might be.
All right, very good. Thank you very much. And yes, it is question answer time. So those of you out there who have listened to Professor Lundblad's presentation and now have your questions in order, go ahead and submit those using the Q&A function at the bottom of your screen. If you're on the phone and want to ask something, you can email that to me at rob_knapp@kenan-flagler.unc.edu. Christian, you said we're at a pretty complicated moment right now, given what the Fed has to work with. Now, on one side, we have the potential for inflation. As you said, this is where people are putting their money right now, that number is going to go higher. On the other side, we have a big jobs number today, but we have also had big revisions in the past. So how do they weigh those, the way those numbers are coming to them? Because in either case, we're not necessarily talking about solid ground, it doesn't feel like.
Yeah. I would say the they in that question is complicated, right? Because the they are a committee of different folks who sit from different perspectives, and you've got the Fed governors and the bank presidents and all who are going to be getting together to meet on this. And if you look at their own signaling of the problem, so you can look at things like the dot plot or some other speech making and the like. I mean, the reality is the Fed itself is in deep disagreement about the relative importance of those different moving parts, I would say. And so there's some who are certainly much more dovish, we would say, that are thinking that the labor market concern is first order and the inflationary pressure is overblown, and think that we ought to be cutting rates and fast. And there are others who sit on the other side, which even before the Iranian conflict were suggesting that, hey, we have not really made all the progress that we need to make on the inflationary side. It's trending in the right direction, but slowly. And so we ought to, if anything, be on hold, or perhaps there's even some who are suggesting we ought to be preparing for a rate increase. And so we're seeing a lot of division within the Fed. And I think it reflects, legitimate intellectual disagreement about the relative weights to put on these two moving parts. I do think a very big sort of wrench that's been thrown into the works over here is the Iranian conflict and the potential for energy costs to sort of come in here and make that all more complicated. And again, it hits along two dimensions. I mean, this is obviously what we've seen in the 70s, and there's plenty of precedent for that, which is it hits you on the inflation side, but it also hits you potentially on the output side, and maybe even worse, a true demand destruction. And so that makes the dual mandate that much more complicated. But again, where is the Fed? The Fed is not in agreement with itself, and it will be the task of Powell and then later his successor to try to navigate that consensus building. And I think that intellectual disagreement is likely to persist. And you see that in a pretty surprising degree of dissent when the Fed is voting. That's not particularly common.
Yeah. Dan Barkin from Business North Carolina with us this morning. Thanks for being here. Dan, he asks, what does that out-migration number mean? That millions are leaving?
Yeah, so we always have a certain number. I mean, just as a matter of course, we have Americans who are exiting. We have foreigners who are exiting. We have plenty of people coming in. I think the interesting number to focus on is the net. And so the net tells you something about, how many people are entering versus how many people are leaving. And really over the the history of that number, and pretty much over the history of the country almost. Perhaps the data aren't perfect, frankly, but if you sort of look back to the 30s and some moments like that, there may be some out migration, but net out migration. But for the most part, this is a country that has attracted more than it has lost, and so that's really the number to focus on. And just if we're going to see true net out migration, that's pretty stunning. And I guess I would say a couple of things there. One is a lot of the job growth that we did witness as a consequence of the grinding our way out of COVID was on with migration coming in. And so again, it's a politically touchy point, and I get it, and there's more to think about than just purely the economic component. I wouldn't suggest otherwise. But from a pure, economic standpoint, I mean, a lot of the job growth that we generated out of COVID was a consequence of that net immigration, and to see a net out migration means then that certain sectors are going to struggle to find the labor that they need, and there'll be some downstream implications for that. And I guess that's sort of point number one. And then the second one is, in the background, I do want to remind there's a demographic component, which is Americans are not having babies at the rate that's needed to replace itself, as are many other parts of the rest of the world. And we've sort of circumnavigated that tension in a way perhaps Japan or parts of continental Europe have not, by attracting people from the rest of the world. And if that's going to be different, then that's going to have some downstream implications too. We pay for a lot of the services that we have promised ourselves in the form of Social Security and Medicare, Medicaid, out of taxing the current working population. And so if that's going to change, that's going to exacerbate some of those government program problems.
Okay.
Yeah.
Okay, so another question for you. How much do you think equity market declines or volatility will impact the real economy? Which channels are most important?
Yeah, so I guess, I mean, the obvious one that we all like to point to is a so-called wealth effect. I mean, clearly there's a great deal of American wealth tied up in the equity market, and so to the extent that equity market declines, make the marginal household feel a little less comfortable making consumption choices that they would have. That's maybe an obvious one, and certainly plenty of models would internalize that sort of thing. I think there's deeper stuff too, which is maybe two components that I would add to that. One is the market has, in its growth over the last several years, been disproportionately tied to a narrative about tech and AI and all of that. And so if any of that is the growth and earnings implications of any of all of that are in question, that's going to be pretty hard to digest, right? So if there's some of that that's going on, which is some unwinding of that optimism, I don't know that we fully see that yet, but if we do, it'll be pretty consequential, simply because that's an unwinding of a narrative, and unwindings of narratives are always complicated. And then the last one I would mention is true volatility. Like the VIX is up, right? So the measure of the volatility of the equity market, and if volatility or uncertainty that we might glean from such measures is up, and that really starts to impair firms' degree of comfort with firing the bullet on capital expenditures. I mean, just take what energy companies are dealing with right now in terms of the volatility that they're seeing as a consequence of the energy stuff. Like, you might think that, the energy price increase because it's the product price for some energy companies is good news. It's more nuanced than that. That dispersion that I showed you is really hard for them to digest. And a lot of them are not rushing in and making massive degrees of sort of capital spend plans right now, because they're having a hard time seeing around the corner in terms of what all this means. So yeah, they'll get a little bit of tailwind, for example. But, in the short run, if energy prices are elevated, this kind of volatility and uncertainty really is a deterrent to firing the bullet on projects, and that carries some long run costs. And so if elevated uncertainty, creates, elongated periods of relatively diminished capital spend, that's bad news for any economy. And so that those I think are some of the places where equity market softening and or equity market uncertainty or uncertainty generally, I think can hit us in ways that are consequential.
Okay. One more quick one. We're often asked by the local news outlets about whether you might have seen anything in this employment report that was of particular interest to Triangle area CEOs, North Carolina in general. Anything that jumped out at you?
Yeah, I wouldn't say anything that's particularly different for our area. I mean, like the bottom line is, we look at numbers like this, and the Fed looks at numbers like this and others as kind of a labor market singular, and there is no such thing. There's labor markets plural. And that means geographic variation. That means sectoral variation. As we talked about, healthcare has been part of the volatility, but also one of the drivers of growth, I guess, sort of over the last several months, last month notwithstanding, and skill mismatch and all of that. And so, I continue to be relatively bullish about our area. I mean, this is one of the fastest growing areas, and certainly the Kenan Institute talks about that in many of its other things. So please take a look at what we're doing over there in terms of variation within the United States. But at the end of the day, there's a lot going for this place. And so there will be sort of general stories, and that's definitely what we were talking about this morning. And then there'll be some variation within these stories. And ours has, I think, a lot going for it in a relative sense.
Okay, very good, and excellent mention of American Growth Project in
Always
there.
happy to, yeah.
I appreciate it very much. Ladies and gentlemen, Professor Christian Lundblad, thank you very much for being with us. We very much appreciate your time. And as you said, it is a fascinating moment. And we'll stay tuned to see what happens next. For all of the media in the audience, if you would like to continue the conversation with Professor Lundblad or any of our other experts, please let me know. You can email me at rob_knapp@kenan-flagler.unc.edu. For everyone in the audience today, thanks for being with us. We appreciate your questions. That always makes the show better. And we hope that you will check out our website at kenaninstitute.unc.edu. Have a couple of things on there that are fairly new. One is the news that registration for our coming conference on market-based solutions for reducing wealth inequality, is open now. We also have our year in review, which is sort of a multimedia kind of thing that you might enjoy, is up now for you to look at. So a good things to find on our website right now, as there always are. A special thanks to a couple of folks, and that would be Tia Smith, who is running Zoom today, and Kyle Henson, who took care of all the graphics. We appreciate everything that you all do. I think that's it for today. We appreciate everybody joining us. We hope to see you again on May 8th. So that's not technically the first Friday of May. May 8th, we'll have registration information up for that briefing up in the next week. So keep an eye out. Thanks again for being here, and enjoy the rest of your Friday.